If you're thinking about using the California Fair Plan to insure your home, there are 3 critically important things that you need to understand to help prevent a financial disaster. Over the last few years, many Californians have been forced to use the California Fair Plan. However, the Fair Plan is not new to the state. It's actually been around since the 1960s. The California Department of Insurance created it as the insurance company of last resort, when no other insurance company was willing to insure your home. The first point that you need to understand regarding the California Fair Plan is that it provides coverage for fire only. You have to pair it with a second policy called a difference in condition, also known as a DIC. That DIC policy includes all of the remaining perils, such as theft, internal water damage, and liability coverage. So the California Fair Plan coupled with the DIC create one traditional policy. The second important point that you need to understand regarding the California Fair Plan is that if you have a mortgage, most banks require that you carry both the California Fair Plan and that secondary difference in condition policy. They're investing in your home by way of that mortgage, and they want to make sure that if there's a fire or if there's a pipe that breaks and causes hundreds and thousands of dollars worth of damage, that the home can be repaired and habitable. They want to make sure that their investment in your home can be recouped, and they do that by way of the home insurance policy. Think about a car. When you buy a brand new car, the finance companies require full coverage, and this is the same with the California Fair Plan and the difference in condition policy. This final point is critically important. The California Fair Plan is the insurance company of last resort. According to California Insurance Code 10090D, it states that the California Fair Plan coverage is only available for properties that cannot obtain coverage through admitted insurers or licensed surplus lines brokers, also known as non-admitted or ENS brokers. Furthermore, a non-renewal by an existing carrier does not automatically qualify a property for coverage under the California Fair Plan. What this code means simply is that if there are alternative options available to insure your home that are not California Fair Plan, whether with a traditional insurance company or a non-admitted insurance company, even if those prices are more expensive than the California Fair Plan, just the fact that they're available makes you ineligible for the California Fair Plan at that point. Furthermore, after the recent Los Angeles wildfires, we've learned that taking shortcuts or making assumptions with the California Fair Plan has real consequences. The California Fair Plan is a great tool when eligible. I hope this video has given you lots of value and answered all of your questions. Thank you for choosing Old Harbor.